Before the break, we were talking about put call parity in context of American options with dividend. So, let us continue from there. We established that this condition C minus P is less than equal to S naught minus K e to the power minus R t holds even in the presence of dividends on the underlying asset, because C gets reduced, P gets increased, the differential gets reduced, and therefore, the less than equal to condition continues to subsist, continues to be satisfied. Now, as was the case in the previous situation where we had put call parity without dividends, we have a long European call, and however, in this case, instead of investing an amount k at t equal to 0, we invest an amount k plus d naught. What is d naught? D naught is the present value of dividend that we receive or we are expecting to receive at any point theta. You are going to receive a certain amount of dividend. The present value of the dividend is d naught, and the future value of dividend at maturity of the option at t equal to capital T is d capital T. I repeat, d 0 is the present value of the, or in fact, if you have more dividends than 1, let us say the stock is likely to give more than 1 dividends, then this is the cumulative present value, the aggregate present value of all such dividends, and similarly d capital T is the aggregate future value of all such dividends. So, we invest an amount minus invest minus means that you are investing, it is a cash outflow. So, k plus d naught you invest at t equal to 0, and this gives you these particular cash flows at various points in time. At t equal to tau, it gives you d tau, at t equal to capital T, it gives you dt, and dt at t equal to capital T. The total figures are given in the last row of this slide. We carry on from this to the next slide, and we construct portfolio B as again in the previous case. Now, here you see the stock is going to give you dividend. So, when you buy the stock, you are long in the stock, and it is assumed that you get your name incorporated in the register of members, and therefore, when the dividend is released for payment, you get the dividend because you are long in the stock. So, you get the dividend of on whatever date it is, and that dividend can be invested to give you d tau at t equal to tau and dt at t equal to capital T. In other words, simply by taking a long position in the stock at t equal to 0, instead of getting a cash inflow of d s tau, which was there in the previous case, you are now getting a cash inflow of s tau, which arises due to the sale of the stock plus the investment proceeds of the dividend that you received during this particular period. So, again if you compare these two portfolios, portfolio A and portfolio B, what you find is in each case you find that portfolio A dominates portfolio B. In each case you find portfolio A superior to portfolio B. Again, this is the future value, this is the present value. So, this has to be greater than 0. So, S t plus d t plus something is greater than S t plus d t, because this something is positive. Concluding this, we again arrive at the inference that the cost of portfolio A is higher than portfolio B, because the cash flows are higher, and therefore, by no arbitrage the cost must be higher. No arbitrage comes into play at this point when you compare the two portfolios. So, because the cash flows inflows from the portfolio A are higher, are superior to cash inflows of portfolio B in all situations, therefore, it follows that the cost of portfolio A has to be higher than the cost of portfolio B, and which gives rise to this condition. The left hand inequality and the right hand inequality has already been established, and therefore, the complete inequality is obtained for stocks that pay dividend. Now, we start a new topic. We talk about trading strategies with options. What do we mean by this? You see, what we are going to talk about here are various permutations and combinations of options with the underlying asset or with among options themselves. Now, before I start talking about this, I would like to emphasize one thing, that these strategies are purely illustrative. They are by no means, by no stretch of imagination, these strategies are exhaustive. What kind of strategy you want to use is entirely up to you. It is entirely your discretion. It is based on your perception. So, that is entirely an investment strategy, investment philosophy. But by way of illustration, we are introducing these strategies to the viewers simply to give them a feel of how the results of the outcomes of strategies can be analyzed, and this, how do these common strategies give, what kind of results these common strategies give us at the maturity of the option. What exactly we are going to do is, we are going to explore the behavior of combinations of options or combinations of underlyings with options at maturity of the options, on the date of maturity of the option. How do they behave? What kind of payoffs we are going to get? So, that is what we are going to talk about in these trading strategies. The common strategies that we encounter are the covered call strategy. Why they are called so, we will come back to it. The covered call strategy, the protective put strategy, we have straddles, we have strangles, we have strips and straps, and we have a variety of spread strategies. I reiterate, these are purely illustrative, they are not exhaustive. You can have 1000 options of one type, 50 options of another type, or 2 options of another type, nobody stops you. It's purely your discretion, and these are purely illustrative. To illustrate the methodology, to illustrate the mechanism by which you can analyze what strategy you want to adopt. So, let us start with the covered call strategy. The covered call strategy is the interaction of the underlying asset and the call option. You have long position in the underlying asset and you write a call on that. You write a call and you have a long position in the underlying asset. So, the first question that I answer is, why it is called a covered call? Why it is called a covered? As you know, what is a covered call? A covered call entails the if you have written a call option, or if you short in the call option, it entails that you will deliver the asset at a predetermined price to the party who is long in the call. If the party is long in the call, invokes the call option, exercises the call option, you are obligated to deliver the underlying asset at a predetermined price. Now, if the price of the asset was to go up in the market, then obviously you would incur a loss, because you have to buy the asset from the market and deliver it under the option contract at a predetermined price. So, your loss would be the price that you buy less than the price that you receive from the party under the option contract. Now, you can protect yourself if at the point of time of writing of the option, you also take a long position in the stock. So, in the event that the stock price rises and the party who is long in the option decides to exercise the option, you already have the stock with you, you do not have to buy it from the market. So, in other words, because the price would go up, the price of your long holding of the stock would also go up, they would neutralize each other, and therefore, that would put a ceiling on your loss. Let us see how actually it operates. That is why it is called a covered call, because your call is covered. Your short call is covered by your long position in the underlying asset. The damage or the detriment that could occur because of the short position in the call due to an escalation in price is protected by a long position in your underlying asset that you take up at the point of writing the call option. That is why it is called the covered call strategy. Let us look at the payoffs. Again, we have two situations, ST is less than K, ST is greater than K. We split the entire price spectrum into two parts, ST less than K, ST greater than K. Since you have bought this stock, the stock can be sold in the market and it will give you ST irrespective of which state arises on maturity, it will give you the market price. What happens to the short call? If ST is less than K, the party who is long will not exercise the call and therefore, the call will lapse and you will not have to make any payoff, neither positive nor negative, there will be no payoff, because the call will simply lapse. However, if the stock price goes up, then the party who is long in the option will definitely exercise the option and make a profit, and you will have to compensate for the profit, because it is a zero sum game. So, in that case your loss is equal to K minus ST, or you can write it ST minus K with a negative sign, because it is a short position. This negative sign indicates a short position and ST minus K is the standard payoff of a call option. So, what do we end up with? ST if ST is less than K and K if ST is greater than K. Your payoff is ST if ST is less than K and your payoff is K if ST is greater than K. Now, what just look at this. If ST is greater than K, your profit is confined to, or your payoff is confined to K. Your payoff is bounded, it is confined to K, and if ST is less than K, again the payoff would be ST, but this payoff arises only when ST is less than K. So, again this is also bounded, and the price that you again we talk about this from the cash flow angle. From the cash flow angle, it is C minus S naught, that this is the cash flow that will occur at t equal to 0 for setting up of this strategy. So, because you are writing a call, this is positive, C is positive, and because you are buying this stock, S naught is negative. So, this is the net cash flow. If you talk about cost, it will be reversed. And let us look at the diagram. Look at this diagram. And now, this is the long stock. As price increases, your profit increases, payoff increases, and this is what? This is the short call. This is the amount of premium. If the long call holder does not exercise, then you get this premium, does not exercise the option, then you get this premium free of this thing, be free of any obligation, and if the long call holder exercises, then you start losing money, indefinitely. Now, what happens up to the point K? See, this is a horizontal line, whereas this is a 45-degree line. Therefore, when you aggregate these two, you end up with a 45-degree line. In other words, up to the exercise price, because the long call will not be exercised, therefore, your profit will be parallel to the profit of the long stock, because the call is not being exercised, it is having no significance, no contribution to your profit, except of course, for the premium that you are getting, and the premium is a constant amount. So, this is parallel to the long stock payoff. This is also 45 degree, but after K, when the market price exceeds the exercise price, then the call starts being exercised. The call will be exercised and you will start losing money. You will start losing money at the rate 1 rupee for every 1 rupee increase in ST, but you will also gain the same amount 1 rupee for 1 rupee increase in ST on your long stock holding, and therefore, these two will cancel each other. Your losses on account of the option written by you will be compensated by the profit that you derive from the long stock position. That is why it is called a covered call, I reiterate. So, these two compensate each other and you end up with a constant payoff in the event that ST ends up greater than K. This is the derivation. The interesting point here is that if you look at this payoff once again, if you look at this payoff once again, you find that this is very similar, very similar. In fact, this is parallel to the payoff of a short put strategy. What is a long put? A long put is like this. And so, there what would be a short put? A short put would be like this. That is precisely what this is. So, the payoff that you are able to generate by a covered call strategy mimics the payoff of a short put strategy. Now, we come to the protective put. Again, first of all, the composition. The composition is you are having a long position in the underlying asset, buy the underlying asset and buy a put option on the underlying asset. The logic is simple, isn't it? If you bought the underlying asset and you are buying a put option, what does the put option give you the right? It gives you the right to sell the asset at a predetermined price. So, when you are buying the asset and you are buying a put option, obviously you want to protect yourself against a decline in a price of the underlying asset. If there is a decline in the price of the underlying asset, then what will happen? Then you will incur a loss on the long holding of the underlying asset, but because you have a put option, you will be able to sell that asset at a predetermined price, and therefore, you will not be affected, you will not be influenced by the decline in price, market price of your holding of the underlying asset, because you are protected by taking a long position in the put asset, and that is why it is called a protective put, because it is protecting your underlying asset. This put option is protecting your stock or your underlying asset against a decline in price. If there is a decline in price, you sell it using your put option, or the option embedded in the put, you use that and you get the price at which you have bought the put option. So, the algebra here is quite simple, and you end up with this expression for the payoffs. Let me go back to the figure. In as far as the long asset is concerned, this is the long asset. As the price increases, the value of the asset increases, the payoff from the asset increases, and as the price decreases, the payoff from the asset decreases. Now, because you bought a put option, what happens? Put option, long put has this payoff. This is the long put. This is the long put, this one, this line. So, you can clearly see that when the price goes up, if the asset price goes up beyond K, beyond the exercise price, then you tend to make a profit, there is no doubt, because you will not exercise the put option. If the strike price or the market price goes beyond the strike price, goes up beyond the strike price, you will not exercise the put option, you will exercise you will sell the underlying asset in the market. Of course, your profit will be reduced by the premium that you have paid in acquiring this put option. So, the profit will be the profit on the underlying asset less the premium that you have paid in acquiring the asset, if the price ends up greater than K. What happens if the price ends up less than K? If there is a fall in price, if there is a fall in price, as you can see in the diagram, the loss on the asset, this is the loss on the asset, is compensated by the profit due to the long put, because you can sell the asset using this long put option, and you end up with a constant payoff, which is this loss can be this amount is partly due to the premium, partly due to the premium that you have paid in acquiring the put option. Let us do a little bit more of analysis on this. What is the sign of this? Well, you can arrive at it from the put call parity. If you look at this put call parity relationship, we have done it earlier. Taking and multiplying throughout by e to the power r t and taking it to the left hand side, we find that this has to be negative. And what is this? If you go back to this, this is the intercept on the This is the intercept on the y axis, k minus p plus s naught e to the power r t. This is the intercept on the y axis. So, if you look at this, if you look at the sign of this quantity k minus p plus s naught e to the power r t, this turns out to be negative. In other words, this will be, this quantity will be negative, this will not be positive, this will be negative. As it is there in this diagram, it follows from put call parity. This quantity, this intercept, y intercept is negative because of put call parity. Of course, here we are considering time value of money. If you do not consider time value of money, you still arrive at the same relationship. Now, we come to a straddle. So, before we talk about straddle, just a word more on this. See this particular strategy, as you can see, is is parallel. The payoff from this is parallel to a long call, and obviously, you would indulge in such a strategy when you want to protect yourself against a fall in price of your holding of a particular asset. Now, we come to a straddle. So far, we have been talking about combinations of underlyings and options, underlying, a position in the underlying and a position in the option. We had the covered call and the protected put, both involved the underlying asset and an option. Now, we talk about a strategy that involves two options, one call and one put. The specialty about this is that both the calls and the put, call is A, put is B, both the call and the put have the same maturity and have the same exercise price. This is again important, same maturity, same exercise price, K is same, T is same. Obviously, the premia will not be the same, premia will be different. Now, look at this. The entire spectrum of stock prices can again be split up into two parts, 0 to k and k to infinity. Now, if the stock price lies between 0 to k, if the stock price lies between 0 to k, then what happens? Does the call get exercised? No, it does not. The put option gets exercised, you get a profit on the put option, and if the stock price ends up between k and st, the put option does not get exercised, it gets lapsed, and the call option gets exercised. This is this part. In fact, you can, it is quite straightforward. You can see from here, this portion represents the exercise of the put option and this portion represents the exercise of the call option. And this is, in fact, these dotted lines are there. This is the long put, and this is the long call. So, for st less than k, the put is exercised, you can see this, and for st greater than k, the call gets exercised. More analysis in this slide. If you look at this long call, st less than k, it is not exercised, so the payoff is 0. St is greater than k, the payoff as usual is st minus k, and long put, the payoff if st is less than k is k minus st, and if st is greater than k, it does not get exercised, and you get no. So, at the end of the day, what is the total payoff that you are getting? K minus st and st minus k. Now, what is the slope of this? It is minus 1, the slope of this is plus 1. So, this is plus 45 degrees and this is minus 45 degrees. As you can see in the previous diagram, this is plus 45 degrees, this is minus, this slope is 135 degrees because it's the slope is minus 1. So, this is 135 degrees. So, that is about the straddle. Now, we talk about one very important thing, and what is the maximum loss? Let us talk about the cardinal parameters first. The maximum loss, the maximum profit is obviously infinity. Why it is infinity? As you can see here, this is infinite. As the stock price increases, every 1 unit increase in stock price is giving an increment of profit of 1 unit, the slope is plus 1. Then the minimum or the maximum loss or the minimum profit, that is P plus C, which is the aggregate premium that you are paying on both of them, and that occurs at what point? That occurs at K, that occurs at the exercise price ST equal to K, when the both the options are what you call giving you a loss of P plus C equal to the premium. In other words, at that point at ST equal to K, the payoff from the call is 0, the payoff from the put is 0. Therefore, the cost of setting up of the strategy, which is what? Which is C plus P. This is the cost of setting up of the strategy, is the net loss that we are incurring. At this point, the payoff from the call is 0, the payoff from the put is 0, and therefore, the entire premium that I have used or that I have paid for, because both are long, please note this, both are long. Therefore, the entire premium that I paid on this put and on this call becomes my loss. In fact, I should be taking the future value of this at this point, but leaving aside the time value of money issue, it is C plus P, which is the loss. This will be C plus P. Obviously, it is negative, it's a loss. And the break even points are K minus P plus C and K plus P plus C, which are, again I can show them to you in the figure. This is K minus P plus C and this is K plus P plus C. This is K plus P plus C, this is K minus P plus C. How they have been worked out? You simply put the profit equal to 0, you get the answers. You put this expression equal to 0, you get ST is equal to K minus P plus C. You put this expression equal to 0, you get ST is equal to K plus P plus C. So, these are the two break even points that you have, one along the put exercise, one along the call exercise. Now, we have a strangle. Before I talk about the strangle, I just missed it. What is the investor perception? That is very important. What is the investor perception? If I take up this strategy, what do I feel? Why would I take up the strategy? Investor perception. Investor perception. Question mark. What is the investor perception if I take up this strategy? Now, as you can see from this strategy, from this diagram, the investor makes a profit. The investor makes a profit in this region and in this region. In other words, the investor makes a profit if the stock price on maturity of the option ends up radically away from the exercise price, either to the left or to the right. And the greater the deviation from the exercise price, greater is the profit. In other words, what is the perception? The perception is that the price is going to move and move radically and move significantly, but the investor does not know which direction the price is going to move. There is some uncertain event, contingent event, which is likely to happen at this point at t equal to capital T, such that the outcome would significantly affect the stock price. And if that outcome is a particular, let us say if the outcome is H for heads, it ends up as a very good thing for the company, and it's going the stock price is going to rocket up. And if the outcome ends to be happens to be tail, then the stock price could go down significantly. But the investor is pretty sure about this volatility, about this fluctuation, amplitude of fluctuation. He feels that there is going to be a significant fluctuation, whatever the outcome is, whether positive or negative, but the price is going to fluctuate. If it is a positive outcome, the stock price is going to jump up, and if it is a negative outcome, the stock price is going to jump down. For example, let us say it is a legal suit, or it is an IPO coming up, and if the legal suit is decided in favor of the company, the stock prices could jump up, and if the suit is decided against the company, the stock prices could go down, but the investor does not know what is going to happen. So, therefore, what he does? He takes this kind of a strategy, and therefore, either case he makes a profit, and the party is going to be, this is called a long straddle by the way. So, let us put long here, this is a long straddle. A party who is, you can also have a short straddle. A short straddle would be the opposite way, this would be a short straddle. So, a short straddle, a person indulging in a short straddle would be betting in favor of small swings around k, small swings in the stock price around k. It does not expect a large swing. A party is long in the straddle expects a large swing in the stock price. Okay. Now, we come to a strangle. A strangle is a variant of the straddle. A variant of the straddle in the sense, in the straddle we had a long call and a long put. The speciality was that the exercise price of both of them was the same. The exercise price of both of the straddle and of the long call and the long put was the same. Here that particular aspect is relaxed. So, here we have a situation where we have a long call and a long put, but K, C and K P, that is the exercise price of the call and the exercise price of the put, is not the same. However, the maturity is the same. So, maturity is the same, but the two prices, the two exercise prices are not the same. Obviously, C and P would be different. Now, we have two situations, K C, that is the exercise price of the call is greater than the exercise price of the put, and K C the other way around, that is K C less than K P. Now, we can divide the entire spectrum of values of S stock price into how many parts? Earlier we did 2 parts, now we have 1, we have 2 and we have 3. 0 to K P, K P to K C and K C to infinity. Now, 0 to K P, in 0 to K P what will happen? Only the put option will be exercised. K P to K C, neither of the two will be exercised. Why? Because the price is greater than the exercise of the put option, therefore, it will not be exercised, and the price is less than the exercise of the call option, therefore, it will not be exercised. And if the stock price ends up greater than K C, then the call will be exercised. So, we have 3 situations: put yes, call no, both put no, call no, and then put no and call yes. I shall continue from here on. Thank you.